Why are foreign governments suddenly dumping US treasuries at an unprecedented rate? Right now, foreign governments are dumping US treasuries at a pace we haven't seen in over a decade. China just offloaded another 21 billion. Japan's cutting back. Even our closest allies are quietly reducing their holdings. And here's what nobody's talking about. If treasuries fall, the dollar doesn't just wobble, it could collapse. That's not fear-mongering, that's math. And by the end of this video, you're going to understand exactly why this matters to your money, your retirement, and your financial future, whether you own a single stock or manage millions. Let me show you what's really happening behind the headlines. Because what the mainstream media is telling you is only half the story. For decades, US treasuries have been the bedrock of global finance. They're called the risk-free asset. Governments buy them, central banks stockpile them. Pension funds build entire portfolios around them. Why? Because they're backed by the full faith and credit of the United States government, the world's largest economy with the deepest capital markets on the planet. But something's changing, and it's changing fast. In the last 18 months, foreign holdings of US treasuries have dropped by over $300 billion. That's not a small adjustment. That's not portfolio rebalancing. That's a vote of no confidence. And when you dig into who's selling and why they're selling, the picture gets even more concerning. China's treasury holdings have fallen from over $1.3 trillion in 2013 to barely $775 billion today. That's a 40% reduction. Japan, traditionally our largest foreign creditor, has been steadily trimming its position. Saudi Arabia, the UAE, and other oil-rich nations that used to automatically rights to infrastructure investments in Asia. Why does this matter to you? Because when foreign buyers step back, someone else has to pick up the slack. And that someone is the Federal Reserve printing money to buy our own debt, or it's domestic investors demanding higher yields to compensate for increased risk. Either scenario is inflationary. Either scenario weakens the dollar. And a weaker dollar means everything you buy costs more. From groceries to gasoline to that vacation you've been planning. But let's go deeper because understanding the mechanics here is crucial. US treasuries and the dollar exist in a symbiotic relationship. Foreigners need dollars to buy treasuries. When they buy treasuries, they're effectively lending to the US government, which creates sustained demand for dollars. That demand keeps the dollar strong. A strong dollar gives the US enormous economic leverage. We can borrow cheaply, we can run trade deficits without immediate consequences, we can impose sanctions that actually hurt because global trade runs on dollars. This system, often called dollar hegemony, has been America's superpower since World War II. But what happens when that cycle reverses? When foreign investors sell treasuries, they're converting dollars back into their local currencies. That's selling pressure on the dollar, it's basic supply and demand. More dollars on the market means each dollar is worth less. And here's the multiplier effect. As the dollar weakens, holding dollar-denominated assets becomes less attractive, which encourages even more selling. It's a feedback loop that can accelerate rapidly once it starts. We've seen this movie before, just with different actors. In the late 1970s, confidence in the dollar collapsed. Inflation hit double digits. It took Paul Volcker raising interest rates to nearly 20% to break the cycle. Think about that, 20%. Imagine what that would do to the economy today with $34 trillion in national debt. Now, I'm not saying we're headed for 1970s-style stagflation tomorrow, but I am saying the warning signs are flashing and most investors are ignoring them because they're too focused on whether the Fed will cut rates by 25 or 50 basis points at the next meeting. Let me give you some context on why foreign investors are losing faith. Because this isn't just about economics. It's about geopolitics, trust, and the weaponization of the financial system. After Russia invaded Ukraine in 2022, the US and its allies froze roughly $300 billion of Russian central bank reserves. Most of that was held in treasuries and other dollar assets. Now, I'm not defending Russia's actions, but from the perspective of other countries, especially those that don't always align with US foreign policy, that move was a wake-up call. Most of that was held in treasuries and other dollar assets. Now, I'm not defending Russia's actions, but from the perspective of other countries, if the US can freeze Russia's reserves, it can freeze anyone's reserves. China's watching, India's watching, Saudi Arabia is watching, and they're asking, the answer increasingly is no. This is why you're seeing the rise of alternative reserve assets. Gold purchases by central banks hit a record in 2022 and remained elevated in 2023. The Chinese yuan is being used in more bilateral trade agreements. The BRICS nations are seriously discussing creating their own currency or payment systems to bypass the dollar. Even the European Union has talked about strategic autonomy, a polite way of saying they want to reduce dependence on US financial infrastructure. Are any of these alternatives ready to replace the dollar tomorrow? No. The dollar still accounts for roughly 58% of global reserve holdings. It's still the dominant currency in international trade, in commodity pricing, in cross-border lending. The infrastructure is unmatched. The liquidity is unmatched, but that percentage used to be over 70% just 2 decades ago. The trend is clear, and trends that persist become realities. So what does this mean for Treasury yields, and why should you care? When demand for Treasuries falls, prices fall. When prices fall, yields rise. It's an inverse relationship. Higher yields mean the government has to pay more to borrow money. With a national debt approaching 35 trillion and annual deficit exceeding 1.5 trillion, even a small increase in borrowing costs has massive implications. Every 1% increase in our transfer rates of $350 billion to annual interest payments. We're already spending more on interest than we spend on defense. Let that sink in. We're spending more servicing our debt than protecting our country. And here's where it gets personal for you as an investor. Higher Treasury yields affect everything in financial markets. They're the baseline. When the 10-year Treasury yields 4%, that's your risk-free rate. Everything else has to offer more than that to compensate for additional risk. If this story about the shifting global faith in U.S. Treasuries kept you watching, like the video, subscribe for more stories like this, and comment what you think about it.